Sir, please start.
Yeah. Okay, students, in this class about various sources of getting funds of the company. Now, this is very important. Once the company is formed, the main thing companies look for is the finance. How the company will be, financial resources will be available from which place. And you require a lot of funds. If it's a manufacturing company, there's a capital investment. With a trading company, you have to keep certain stocks. So funds remain to be very important once you start the company. Even the preliminary expenses are on the basis of which the company has been started. That is supposed to be returned to the promoters. Now, promoters can take shares instead of taking money, but the preliminary expenditure for forming the company has to be returned to the promoters. So normally, what happens the moment company starts, the promoters give their contribution in the form of payment for equity shares. That is the basic fund, seed fund of the company, and company starts. But moment it wants to do the business, a huge capital investment is required. Now, this capital investment may come from bank or it may come from the shareholders themselves. When it is given by the shareholders themselves, we call it own capital, capital by the owners. And when you take the money from others, from the bank, it is called loan capital. So there are basically two sources of funds of a company, and that is also recognized under the company law. That company can take money from the shareholders in the form of equity capital and preference shares, and they can take loan. The loans are basically two types. One is term loan, and the other is called short-term loan. So term loan is from the banks, and you can take loan by issuing debentures, either from any individual, either from a bank, or from the public, or from some known people. So this is the basic concept of financing. But you need to have a balance between the two, because if the company wants to run its own capital, you need a lot of paid up capital. At the same time, if the company thinks that they will run only on loan, that is also not possible, because bank will not give you unlimited loan. And there is a limit to making loan in a company. Now, when you talk of loans here, we are only talking about long-term loan. The Companies Act do not talk about short-term loan. Companies Act is only confined to long-term loans, which are in the form of term loan or in the form of debenture or bonds. Normally repayable after 5 years. Normally repayable after 5 years. Now, the basic concept is that we need a share capital. We need to know the concept of share capital. The basic concept of company is a joint stock company. Well, people will have stock. Stock means shares. That means the capital of the company will be divided into various number of shares, and each of the shares will have a number. Each of the share will have a number, and it has to have a face value. What is face value? Face value is the value which is mentioned in the accounts of the company. Face value is available in the memorandum association. When you register the company, you have to declare what is your capital. And there you write so and so company. The company shall have, let's say, 10 crore of equity capital divided into shares of rupees 10 each. That means 1 crore shares of 10 rupees totaling to 10 crores. So this is the language of the memorandum association. So each of these shares will have a distinctive number, and you can increase or reduce the capital as per the provisions of the Companies Act. Now, when you buy a share, you have to buy this share in full. That is, you buy 1 share, 2 shares, 13 shares, 40 shares, whatever it is. Now, who can buy this in case of private company? Only your friends, relative, known people can take shares from the company, and that will not be more than 200 number of shares. including the promoters and their known people, relatives. This 200 excludes employees. This 200 excludes employees and employees who were given the shares when they were employees. But they are not employees now. Language is very clear that those people who have been given shares when they were employees and they are now they are not employees but they are continuing to hold the shares. So these people are not calculated while calculating 200 number of shares in case of private company. But with the public limited company, there is no limit of number of shareholders. And obviously, private company cannot invite capital from the capital market or from others, which can only be done in case of a private public limited company. Now, there are some shares which can have a differential voting rights. That is called shares with differential voting rights. They are equity shareholders, but equity shareholders of one group will not have the same rights and liability of the equity shares of another group. So that is a different issue. I'll talk about it a little later. That is called shares with differential voting rights, which can be varied with three-fourths majority of that particular class. Now, as I told you just now, that the share capital can be altered, it can be reduced, it can be cancelled, and the debenture can be converted into equity share. The equity share can be converted also loan. Now, this is what we understand about the initial formation of the capital. Now, let's talk about equity shares. Now, equity share is basically share which is owned by the company. Equity shareholders are considered to be owners of the company, and they are permanent owners. Permanent owners means they will continue to be the owners of the company as long as they are, as long as the company is continuing. There are two situations where they may not remain to be equity shares, or they can reduce their stake. They may remain to be equity share, but they reduce their stake. There are two situations in company law. One is reduction of share capital. Reduction of share capital is a situation when the assets of the company is reevaluated. When the assets of the company is reevaluated, you find that the total assets which is appearing in the balance sheet is much more than what is the actual value of the asset. So on revaluation, you try to make the balance sheet realistic. And when you make the balance sheet realistic, what you do? You reduce the assets by revaluation. So once you reduce the asset side of the balance sheet, you have to reduce the liability side of the balance sheet. The moment you reduce the liability side of the balance sheet, you have to reduce the share capital on the liability side. This is called capital reduction. And the other way is to buyback of shares. Some of you might be knowing about buyback of shares. There is a specific regulation under the Companies Act, and there is a rules also, buyback regulation, where the shares can be bought back by the company. This normally happens in case of overcapitalization, when company has more capital than required. So what the company does, company will offer to buy the shares from the market, and the existing shareholders will offer to sell the shares. Normally, buyback is more than the price in the market, otherwise nobody will offer the shares. Once you go for buyback, you offer. Suppose now, I think TCS buyback is open. TCS buyback is open. So what happens? The TCS shares is around, let's say, 3,400. So they'll buy back at a higher price. What will happen? Many of the shareholders will offer their shares to be bought back by the company because they will get a premium on that. But even when they all of them, give the shares, it is not necessary that that will be accepted by the company. Company may suppose I'm in 100 shares and I will offer 100 shares to be sold back to the company because I'm getting a higher premium. But the company may not accept 100 shares. Company may accept only 20 shares. So 20 shares will be bought back by the company at a higher price, and 80 shares will remain with that shareholder. This is the concept of buyback. So I just told you that Shares basically are those shares which remain with the company till the company is there. And even when the company is closed down, equity shareholders get their part at the end when everybody is paid. So while differentiate between equity and preference share in both of time, but equity share had a voting right and they can vote. That is a very big right of equity shareholders. They can vote in the general meeting and vote. And in case of ordinary shareholders, the voting is totally not only ordinary shareholders. For any shareholders, voting is proportionate to how much shares you are holding. And that is basically what is called corporate democracy. In corporate democracy, the holding is as per voting. You've got 1,000 shares, you've got 1,000 votes, you've got 10,000 shares, you've got 10,000 votes. So there is a difference between political democracy where your voting is only one. You've got only one vote. You may be a big person, but you've got only one vote. But in case of corporate democracy, the person who is holding, why promoters can control the company because they are holding more shares. So they have got more votes. But retail shareholders, their voting rate is very less. But please keep in mind, retail shareholder is always with the promoter. Because whatever promoter says, they will agree to that. And that is the reason they purchase. Just imagine a person who has purchased Tata Steel shares. When he goes to the general meeting, and if the management proposes something, it is the retail shareholders will agree. So it's a very rare case when the retail shareholders do not agree with the proposal of the promoter. Now, the second holding in our country is the institution. Institutions hold a huge shares of various companies. Now, they've got a huge voting rights, sometimes 4%, 5%, or maybe 10% of the shares of that company. The promoter tries to keep these people in a good humor so that they don't create any problem. Sometimes, there is an agreement also made with the institutions that if you're offloading, if you're selling the shares, you have to first offer to the promoter or you have to give a notice. So that kind of arrangement can be there. So what do we have who are the people who hold shares in that case in a company? You can take any listed company, you can take ITC, you can take TCS, you can take any company. You will find that is the promoters holding the majority. And next you have the financial institutions and banks. You can include international financial institution also. And the balance remains with the public. The balance remains with the public. Now, a company also can be shareholder of another company. So we will find in some of the company, some other company is also holding percentage of shares of that company. And in case of government company, 51% is held by the government, central government, state government. In case of joint sector, 26% more is held by the company. But in other cases also, there are instances where the central government holds few shares in some of the companies, which is less than 26. So this is how equity shares are distributed. And equity shares, cannot be issued at a discount other than the loan is converted to equity under the resolution plan. Otherwise, equity shareholders remain to be very important shareholders of the company. And when you talk of equity shareholder, there is something called sweat equity. Sweat equity is given to the directors and the employees. It is allotted to them. And you've got employee stock option plan. Employee stock option plan. An option is given to the existing shareholders that they can take the shares of the company with the option period. The option period can be 3 years. So within 3 years, they can take, let us say ITC. ITC share is trading at 440 rupees maybe. So ITC can say that I'm giving option to these people, these employees of the company. They can take the shares of ITC at 410 rupees for next 3 years, whatever may be the price, they will get it 410. Now this is basically reward to the employee because they are issued, stock is issued at a discount, and therefore they get the shares of the company at a discount. And when they keep the shares for a long time, the value of the share increases. So that by the time they leave the company, they have huge stock option on the company. The stock option is considered a perquisite. So difference between the market price and the issue price will be considered to be your income, and it will be taxed during the year of allotment. So this is so far equity shares are concerned. I will now talk about preference shares, which also happens to be very important, and this is there in many of the companies. Is there preference share? Now, since the word preference is there, now since word preference is there, it basically means that they will get preference than the they will get preference than the uh, equity shareholder. So what preference they will get? Let's see why they are called preference. So first is the what are the features in preference share to be redeemed within 20 years. Redeems mean the principal is repaid. That is called redemption. People must have heard of redemption of debentures, so the principal amount of debenture is repaid. So preference share has to be paid within 20 years, the principal. 30 years in case of infrastructure company, the repayment period is 30 years. So that means they are owners of the company, preference shareholders, but they are temporary owners of the company. They are not permanent owners of the company. Or if the redemption period is less than 10, 20 years, maybe 10 years, so they will be owners of the company for 10 years. Now, in the normal course, they don't have voting right, but they will vote where if it affects their rights directly. In case of winding up, they can vote, or in case of repayment or reduction of capital, these preference shareholders can vote. Now, what preference they'll get next? They'll get two preferences. Not mentioned here, but anyway, they'll get two preferences. The first preference is preference in dividend. They will get the dividend first. They will get the dividend first. Now, whenever the company makes a profit, the dividend will be paid to the shareholder at a predetermined rate. So the rate of preference share is predetermined. Predetermined rate at the time of issue is decided 12% preference. It means that they will get 12% once the company makes profit. But here also there is a catch. The catch is that supposing that company pays has issued 12% preference shares, but the company has made a profit where the company cannot pay more than 6%. It can pay dividend up to 6%. Now there can be two situations. You paid 6% dividend to the preference shareholders and forget everything. Or there can be an arrangement where you say that I am paying you 6%. Since you have agreed for a 12% rate of dividend, I am paying you 6%. Next year, if we make profit, adequate profit, we will pay you 12% as it is as per the agreement, and we will also pay you the 6% which you could not pay this year. Now, this arrangement can also be there. These shareholders are called, participating preferences. Have any copy, you can note down. They're called participating preferences. And the other type of preference share is convertible. Now, when you say convertible means it will be converted into equity shares in course of time. Let us say issue preference shares of rupees 100, and the term says that this is a 12% preference share. That means you will continue to get 12% interest, and then you I'm sorry, the earlier which I told, that is called cumulative and non-cumulative. That is, the dividend is being cumulated. If you do not pay, it is cumulated next year. And this is called convertible and non-convertible. In convertible, the preference share is converted into equity share. Let's say you purchased the equity share of 100 rupees and it says that it will be converted into 5 equity shares after 5 years of rupees 10 each at a premium of rupees 10. So 10 is the face value after 5 years and 10 is the premium. So 20 rupees per share, your 100 rupees preference shares will be converted into 5 equity shares at a premium of rupees 20. If the market price is more than 20, you are benefited. If the market price is less than 20, you are not benefited. So this is called convertible and non-convertible preference. If there is no provision of conversion in the preference share, they are called non-convertible. If there is a provision of conversion into equity shares, they are called convertible. Okay. Any participant having any question? Anybody having a question, you can write down or you can ask whatever it is. Am I audible to the participant? Whoever there? It appears there are only 3 participants, 4 participants. Anyway. So this is about preference shares. Now we go to another type of rights of a shareholder, and which also is source of capital. Bonus shares is not a source of capital. Right share is a source of capital. So what is this right shares? Whenever a company decides to increase the share capital, they will first offer to existing shareholders. The law is quite clear. Now, supposing that 100 people have formed a company by paying 1 lakh each, and the capital is 1 crore. And after 1 year, they need more money. So they'll go for loan. So you may not get loan. So to go to the bank will say, okay, increase your equity capital, I'll give you loan. You go for loan of 5 crores. The bank says your capital is only 1 crore. To increase your capital, paid up capital to 2 crores, I'll give you 3 crores loan. So you need another 1 crore loan. Or maybe another 2 crore loan, whatever. Now just see that whenever you go to outsiders other than the existing shareholder, what will be your post-issue situation? After the issue, what will be your situation? You are the promoters of the company, but now you are only holding 50%. New people have come 50%. If you require more 2 crores, what happens? You become 33% shareholder. Others are 66%. The company has gone out of your control. So therefore, the company law has given a very rational idea of rights issue, that whenever the company wants to make further issue of capital or wants to improve the share capital, first they have to offer to the existing shareholders. That's called preemptive right. But if the shareholders decide, that the existing shareholder decides that no, we'll go to the market and we'll take shares from the other outsiders. That is possible. So what happens in rights is that there is a proportion. Let us assume that a company is having 1 crore paid up capital and it wants to increase the paid up capital to 2 crores. So the best possible option is to issue 1:1 right. That means those who are having 1 share will get another share. Those who are having 10 shares will get another 10. And the price has to be less than the market price if it is a listed company. If it is not a listed company, there won't be any market price. In that case, you have to decide a price, and that price should be attractive so that the existing shareholders contribute to that right. Now, here an option has to be given to the shareholder either to accept or not accept. So they'll give in 15 to 30 days time by which they will give their rights along with the application money. Maybe the 1:1 right and everybody agrees to take the shares allotted to them. what will happen? The same shareholders will continue in the same proportion. But that is very unlikely. It is very unlikely. So what happens? Maybe some people may not apply for shares. So here the company law has given an option that suppose your capital is 1 crore, you are issuing 1:1 rights. After the issue, it will be 2 crores. Your issue size. The size of the issue is 1 crore. Now let us assume that 70% of the existing shareholders do not apply, do not subscribe to the rights. Here the company law has a provision that others can apply for more. Others can apply for more. Let us assume that one shareholder is entitled to get 100 shares. He applies for 200 shares. Additional. This is called additional application. So he can get from the shares which are not subscribed by others, that 30%. He will get from that 30%. But assume a situation where 30% people has not applied, but the shareholders who have applied for additional, that additional amount comes to, let us say, 60% of the total share capital. Additional. So in that case, company has to allot on pro rata basis. Now the pro rata is very clear. 60% is not taken by some shareholders, but they've got application of 60%. Sorry, 30% has not been taken by the shareholders, but 60% have asked for it. So they can give double to these people. So there can be a proportion of these people who have asked for additional shares. So additional share, what will happen? The 100 share wala will ask for 100 shares, will get 50 shares. The moment all these people get 50% of their application, the issue size becomes 1 crore. Then everything is settled, everything is fine. So this is the concept of rights issue. Interestingly, these rights issue forms can be transferred to others also. This is called relinquishment of right. The form has come to you, you got 100 shares. You give it to somebody else officially. That somebody else will get the shares. It will come in his name. Because you have relinquished the right to take the share. That person will apply from his own money. Shares will come to him. Again, there is another option. You are entitled to 100 shares. You decide to take only 50 and you want to relinquish another 50. That also you can do. You give it to somebody who is interested to take 50 shares. So this is what happens in case of right. We come to another situation that is called bonus shares. Bonus shares is basically capitalization of reserves. What happens is that when companies form, so first they make profit. Once they make profit, what they have to do, they have to give dividend to the people. And they'll retain some money. What is the normal appropriation of profit? You make a gross margin, that is gross profit. After gross profit, you provide for depreciation, you also provide for income tax. After you provide for depreciation and income tax, you get the amount which is called profit after tax. This profit after tax is called distributable profit. This can be distributed. What will do with this profit? You pay dividend to the equity shareholders. And the balance will remain with the company. That will go to the reserves. Every year that goes to the reserves. Now, depending on the requirement of the company, the board of directors can decide how much amount has to be given as dividend and how much amount has to be kept as reserve. So in many cases, the company keeps a reserve every year, and after some time, you find the reserves are proportionately very high compared to the share capital. Maybe the share capital is, let's say, 10 crores. and about reserves of, let us say, 300 crores. This situation remains to be very disproportionate. What companies do, they increase their share capital. How? By reducing the reserves. So if 300 crore reserves becomes 290 crores and your capital is 10 crores, so they give 1 is to 1 bonus. Moment they give 1 is to 1 bonus, 10 crores from reserves will be converted into equity shares. And bonus shares shall be issued to the shareholders. In the normal course, after the bonus shares, value of the share will be almost half. So see, the same assets of the company, same value of the company is now being shared by how much? 2 crores shareholders. Earlier it was 1 crore. I'm sorry, 10 crores. Now it is 20 crores. But the value of the company remains same, let us say. So the value is almost half. But again, in course of time, we'll find in stock exchange also that again share prices slowly goes on increasing. So bonus share is a big benefit to the shareholder, existing shareholder. So this is how bonus shares are issued, and this is the purpose. What is the purpose of bonus in that case? To increase your paid up capital. That is also very important. Because paid up capital is one of the basis of determining the quality of the company. Moment a company goes to RBI, goes to any bank, or goes to any other authority, the first thing people ask, what is the capital? Paid up. Paid up is the capital which the company has received. The money which is entered in the bank account of the company. So they will ask you, what is your paid up capital? This is the reason of increasing the paid up capital. Okay. Established company always issue bonus shares. I was talking about reduction of capital and repeating a bit, cancel the portion unrepresented by asset, as I told you, and payback capital not considered to be surplus. And buyback, I told you, I've not written here anything. So buyback you read from the rules of the company. So this is the all the capital side of the company, and these people are the owners of the company. So the share capital is increased from the first issue, and can have an IPO, initial public offer, and FPO, follow-on public offer. Company who is already made initial means company is coming to the capital market for the first time, and here company can take issue shares at a premium also or at par. Par means 10 rupees share, 10 rupees. But normally nowadays you will find that shares when they come to the capital market, they initially they ask for huge capital because they are some of the companies are established companies, they are making profit, having reserves. So as per their advisors and merchant bankers, the value of the company is very high, and therefore when they're coming to the capital market, they come with premium. The premium which they take goes to an account called share premium account. That is also shareholders fund. That fund belongs to the shareholder. So this is all about share capital of the company. Now, any of you have any questions, you can just put it or write it down. Okay. So I'll go to the next. I'll go to the next subtopic, that is the same, that's for debenture, which is for loan. Now, I think we can take, suppose 4 years, we can take a 5-minute gap Goppa, can you hear me? Now we can take a 5 minute gap in between and I'll proceed to the next subchapter. Okay, now I'll talk about the other thing that's called debenture. Now, debenture is a long-term loan for the company, and it is considered to be very, reliable and very fixed kind of a source of long-term loan. The first thing is, what is a debenture? Debenture is a certificate issued by the company where the company acknowledges a long-term debt. Company says, yes, I've taken loan from this company, but this much is the interest and it will be repaid within this date. The date of repayment payment is called redemption date. The redemption is to reduce, to extinguish. Now, debenture period is 10 years. In case of infrastructure companies, it's more. And some of the companies which are permitted RBI or CG or National Housing Bank, they've got a more redemption time. Now, here I'll just tell you about the various types of debentures and how these debentures are helpful both to the company and to the shareholder. Sorry, debenture holder. Now, please keep in mind that this instrument has to be made into features where the company also is benefited and the investor is also benefited. The investor is only benefited, company is not benefited, company will not issue. On the other hand, if the company is benefited, the investor is not benefited, investor will not buy the debenture. So there has to be a win-win situation for the both people. Now, what is the win-win situation here in case of debenture? Now, debenture is a loan where the investor is getting a fixed amount of interest and his principal shall be repaid after certain date. The debenture interest is normally more than the bank. Therefore, instead of going to the bank, we go for debenture in company. For the company, it is a long-term source of money. Of course, again, it is a loan. Debenture is also a kind of loan. But there are certain benefits more than what I'm saying. For the investor, the debenture can be convertible debenture. Convertible. It can be converted into equity. In the normal course of time, debentures do not have a voting right unless their principal or interest is not paid in time. In that case, they can have voting rights. They'll move to the National Company Law Tribunal where they may be given voting rights. Now the question is how debenture will be repaid. The company law has made a very good provision which says that moment you issue a debenture, you make a debenture redemption reserve, a special account where you can transfer profit from the company. Let us say you issued a 10-year debenture of 10 crores. After 10 crores, you have to repay 10 crores. Where from will get 10 crores? So in order that you can pay this 10 crores and the investors are protected, the company law provides, the rules provide that you have to create a debenture redemption reserve where you have to transfer 1 crore each year, every year, so that after 10 years, there is 10 crores in that particular fund. And from that fund, you can pay direct to the debenture. It's called debenture redemption reserve. Now, debenture can be convertible, as I told you, convertible and non-convertible. Come to it, debenture types. But as I told you, since it's a borrowing, you have to uh, uh, take care of the rules of borrowing. What is the rules of borrowing here? The authority to borrow is the board of directors. So the board of directors are limitations of the borrowing power. And the limitation of borrowing power is the amount equivalent to paid up capital and free reserves of the company. Now, what is this? Let us say company is having a paid up capital of 10 crores and having a free reserves of 30 crores. Free reserves are those reserves which are not specific reserve, that is, they are not kept for any specific purpose. Just now I told you about debenture redemption reserve. Debenture redemption reserve is not a free reserve because it is totally kept for a particular purpose. Now, what is the purpose? Purpose is to redeem the debenture. So it is called specific reserve. So suppose the company is having a paid up capital of 10 crores and 30 crores of reserves which is not specified for any purpose. That will be called a free reserve. The total is coming to 40 crores. Here the board of directors can take issue debentures or borrow money, including debentures and other loans from banks. The maximum power to borrow will be 40 crores. But supposing that want to take more than 40 crores, they have to take approval of the shareholders. The logic of taking approval from the shareholders is very clear that since they are taking more loan, they are exposing the company to more risk. And therefore, shareholders should know it. Shareholders not only know it, they should give their consent to it. Okay. Now the question is, shareholders agree. Can the company take unlimited loan? Company cannot take unlimited loan, but the Companies Act do not provide any limit. Companies Act do not provide any limit to the shareholders. That if shareholders also, when loan is taken with the consent of the shareholders, what is the limit in that? There is no limit mentioned in that case. But it will be controlled by the person who is giving the loan. You will ask for equity. I won't give you loan unless you have got adequate equity. That's called debt to equity ratio. Debt equity ratio. So this is the borrowing powers of the company. Very important for all of you to know the borrowing powers. Now I'll talk to you about the various types of debentures which you have. The most common type is convertible and non-convertible debenture. As I told you, in case of convertible debenture, the debenture is converted into equity share. In case of non-convertible debenture, they continue to be debentures till the end. They continue to be debentures till the end. Now, why convertible and why non-convertible? The concept of convertible is that the person who is giving me loan is associated with me for a long time, let's say 5 years. Now I want to increase my capital. So instead of bringing in new investors, let us prefer the existing people, investors who have given me loan. So let their loan be converted into debenture. And normally when this conversion happens, the price of this is more than the conversion value. Price will be more than the convertible value. Now let us take a case that a 100 rupee debenture, it will be converted into 5 equity shares after 5 years at a premium of rupees 10. At a premium of rupees 10. So 100 rupee debenture will get 5 equity shares at a premium of rupees 10. And after 5 years, the price of 10 rupee shares will be more than 20 rupees in the normal case. Maybe it is 40 rupees. And so imagine the gain which this debenture holder is making by getting the shares at half of the price. So this is the benefit of convertible debt. But it can be otherwise also. It can be otherwise also. There are a number of cases when at the time of conversion, the price market price is less than the issue price. I don't want to take the names, but this has happened. That you have given a convertible debenture, it says that your shares will be converted, your debentures will be converted into shares with so much of premium. Let's say 10 rupees share will be converted into a share of 50 rupees by another 40 rupees of premium. After 3 years, you find that the price of the share in the market is 32 rupees. So there's state loss of 18 rupees. But you have to convert it mandatorily. Here you cannot say that I will continue to be a debenture holder since I am getting interest on my 50 rupees, 100 rupees. But it will be compulsorily converted into equity share because that is the terms of issue. So this is the difference between convertible debenture and non-convertible. Okay. Now, when you talk of convertible debenture, also there can be fully convertible. The whole debenture is converted into equity shares. Or there can be a provision where it says that a debenture is 100 rupees. 50 rupees will be converted into equity share of rupees 10 after 3 years at a premium rupees 40. You get one shares for 50 rupees at a premium rupees 40. And the balance 50 rupees will continue to be debenture for let's say another 7 years. The conversion is taking place after 3 years and balance 50 rupees is remaining as a debenture up to the tenure, that is 10 years. This is called partly convertible debenture. I presume that the concept of partly convertible and fully convertible is clear to you. In case of partly convertible debenture, part of the debenture is converted into equity share and the part remains to be a debenture. In case of fully convertible debenture, the whole amount is converted into equity share. Or if it is a non-convertible debenture, it will not be converted into equity share at all. It started with debenture and it will remain as a debenture till it is repaid or till it is redeemed. So this is the concept of fully convertible and partly convertible debentures. As I told you, the benefit of fully and partly convertible debenture depends on what will be the price of the shares once they are listed in the exchange, or what is the price of the shares when your conversion time is coming. There are cases when they issue the debentures, the price is very high. And the investor is very happy saying that, oh, after 1.5 years or after 2 years, the share price is 200 rupees. I will get at 120 rupees. So let me go for the debenture. But after 2 or 3 years, when the conversion time comes, instead of 200 rupees, the share price is at 100 rupees, and your conversion is at 120 rupees. You are at a loss. Now this problem was settled by a very big company who issued 20 shares in 1992, and they gave the option to the investors. They are saying that when the conversion time is coming, depending on the market price of the shares, let the debenture holder decide whether he continues to be a debenture holder or he wants himself to be converted into a shareholder. So with this logic and this concept, first time in India, something was floated that is called optionally convertible debentures. Called optionally convertible debentures. Whether we will convert it into equity share or not, that option will remain with the investor. The investor will ask, company will ask for your option before the conversion date, maybe before 1 month of conversion date. You have to give an option whether you want to be shareholder or want to continue as a debenture. To go to another type of convertible debenture on the basis of security. Now, question is that, as I told you, The debenture is a loan. So whenever you give a loan, when somebody gives a loan, the first thing comes to that person is what is the security against the loan. And all of you know secured loan and unsecured loan. In case of secured loan, there is some security given to the lender. In case of unsecured loan, there is no security. Normal vendor loan, trade loan, your vendors, your suppliers, they're all called trade creditors. They don't have any security. Unless the company specifically takes any security, that is a different issue, but they don't have any security. So they are giving the material. If you do not pay for them, there is no security with them. They are called trade creditor, unsecured. Here also in case of debenture, you can have a secured debenture and unsecured debenture. In a secured debenture, what happens is the security is created. Now, if you are giving debenture to 5 people, you can just transfer some security to the 5 people. Or if you are taking loan from 5 banks, so the company can give some security, building to one, factory to one bank, stocks to some other bank. So it is possible. But when you are making a public issue of debentures, let us say maybe let's assume 5,000 people will be taking the debenture. To whom you are going to give the security? Now, SEBI has made regulations of regulating and solving this problem. The SEBI regulation says that if the company is issuing debentures whose maturity period, that is repayment period, is more than 18 months to the public, it cannot issue unsecured debentures. It has to issue secured debentures only. It will only issue secured debentures. Now the question is how to create a security. Here you have to bring in a third person who is called debenture trustee. Trustees to the debenture holder. Now these debenture trustees are supposed to be SEBI registered. So what you need? You need a SEBI registered debenture trustee. What is the mechanism? The security, let us say plant and machinery is the security which the company wants to give. So plant and machinery shall be mortgaged to the debenture trustee. And what is the role of the debenture trustee? Debenture trustee will protect the debentures. Protect from what? Protect from any loss. What is the loss to the debenture holder? He doesn't get the interest in time, or he doesn't get repayment at time, the due date. In this situation, the debenture trustee will come in, and since the property is mortgaged to the debenture trustee, mortgage is a conditional interest. And what is the condition? The company voluntarily agrees to a mortgage deed that if I cannot repay the debentures within that time, the debenture trustee shall have the right to take over the property and sell that property and pay the money due to the debenture. This is a very voluntary arrangement company makes. There is no compulsion. If the company making a public issue, company giving a declaration, voluntary declaration, that this is the mechanism of doing the job. And this is how the security is created. Now, how do people know? Moment the security is created, you have to register the charges. Charge, all of you must be knowing that whenever the company takes any loan and mortgages any property, so that property will be called as charge property. That is, somebody is having a right. Charge is a right. Charge is a right on the property. So this is how secured debentures are. Now, on the basis of interest payment, very interesting that we have got fixed rate and floating rate. In fixed rate, the rate of debenture may be for 10 years or 5 years is fixed, 9%. But it so happens that the rates in the market go on changing. What happened long time back in IDBI? IDBI issued some debentures at the rate of 12%, which was the rate at that time. But in course of time, the interest has started falling. And at one point of time, interest was 6.5. Now it was very difficult for IDBI to pay interest of 12% when the market rate is 6.5%. So what IDBI did, they called back the money. They are saying that please surrender your debenture certificates. I'll pay you the money, your principal amount. The question is, can it be done? Yes, it can be done if there is an option available there, and that option is called call option. Call option is the option where the investment will be called back. The investment can be called back by the issuer. And this is a situation which arises when the issue price, the interest rate is higher at the time of issue and it has fallen. So the company is not able to give you that kind of interest, and the company will say, okay, please return the debenture certificates, I'll pay you the money back. This is called call option. Now the situation can be just the reverse, where the investor has taken a debenture at the rate of 6% for 10 years, and after 2-3 years, the interest in the market is going up 7%, 8%, 9%. So investor will be interested to take out the money from the debenture and put it somewhere else where he will get 9%. The question is it possible? Answer is yes, it is possible if there is an option which is called put option, PUT put. The put option is the option available to the investors, where they can surrender their debentures and get back their. Now, in order to solve this problem, a new financial instrument has emerged that is called floating interest rate bonds or floating interest rate debenture. It says, suppose I've taken a debenture of 10% today for 10 years, and after some time the interest rate falls, I'll be getting the fallen interest rate, not 10%. On the other hand, I've taken a debenture of, let us say, 7%. The interest rate goes on increasing. And after 1 year or 2 years, the interest is 10%. So I'll be getting 10%, not 7%. So this is called floating interest rate debentures or floating interest rate bonds, where the interest rate is floating, it is not fixed. The last category of debentures is called zero coupon rate bonds or zero coupon rate debentures. And here there is no interest on the debentures. The question is, if there is no interest on the debenture, why people will take it? People will take it, investor will take it when they get on discount. What is this? Suppose there is a debenture issued by, let us say, National Highways Authority. Or IDFC. But they say that I'm giving a debenture today, and in 2032, whoever to surrender this debenture, you will get 10,000. So obviously 2023 will be buying at a lesser rate. You will discount the debentures from 10,000. Every year you will go on discount. Maybe at a certain rate of interest linked to the inflation rate. And let us say we arrive at a rate of that 5,200 rupees in this date. You are ready to take the debentures at 5,200 rupees, and you will get 10,000 rupees per debenture in the year 2032. Now this is called discounted dividend or discounted bond. But in case of zero coupon rate, when you say that it is not discounted, so what is your benefit? Is sometimes a coupon is given with the zero coupon rate where you get a shares free of cost or a share at a very lesser price. Okay, that is called a warrant. Some benefit is attached to the zero coupon rate. And lastly, I'll talk about deep discount bond. When the discount is very high, it is a long maturity bond. There is something called long maturity debentures, where the maturity is more than 20 years. And I think I forgot to tell you that the company that allows to be perpetual debentures can be permanent. That means as long as company is existing, debenture will be there. A deep discount bond is when the discount rate is very high. You've taken a bond, let us say it says in 2048, in 2048, you will get 10,000 rupees against this debenture. You have to discount for 20 years and then come to the present value in order to decide whether you take the debenture or not for deep discount bond. Now, these are some of the terminologies which you people should know. Issue at par premium discount, I told you. FI means financial institution. PFI means public financial institution. All government banks are called PFI. Apart from that, the ministry will announce, the government of India will determine and declare from the time to gazette notification that this institute is declared as public financial institution. FII means foreign institution investors. This means that they are foreign institutions. They can be foreign bank, foreign financial institutions who hold shares in Indian company. But when an investor is holding directly in a company, the investor can be an individual or a company is directly holding shares in Indian company. We call it foreign direct investment. Okay, farm allotment is a word which means that we will definitely get allotment. What is farm allotment comes in case of right shares? As I told you, they've got 100 right shares and the company is 1:1. So your farm allotment is another 100 shares. You will get farm. Definitely will get. Oversubscription is a situation when company is making an IPO and let us say the issue size is 20 crore. Issue size of the issue is 20 crore. There's always an issue size aggregating to so much. Issue of so many shares at this premium aggregating to let us say 20,200, 20 crores, 20 lakh. Now, if you get more application than what is required, it's called oversubscription. If you got lesser application than your issue size, it is called undersubscription. In case of oversubscription, you cannot give shares to everybody. You make a ratio. To make a ratio as to allotment, and that is what is called as basis of allotment. On what basis we have given. So there can be various bases saying that those who have applied for 200 have been given 100 shares. Those who applied for 100 have been given full 100 shares or 50 shares. Or those who applied from 100 to 400 were given 100 shares. Those who applied from 500 to 800 were given 150 shares. So this is called basis of allotment. This only happens in case of oversubscription. But if the under subscription, if the subscription is not 90%, then it's called minimum subscription. That is called minimum subscription. What is minimum subscription? When an issue is made, the company, if it doesn't get minimum of the 20%, minimum size of the 20%, it is called the issue has flopped. Called issue has flopped. 90% is the minimum. Prospect is the document where all details of the issue is mentioned. A very kind of a booklet where everything, the purpose of the issue, the status of the company, the status of the directors, associated companies, holding companies, subsidiary company, all details will be there in that prospectus so that Before putting money there, investor can know about the company.